All right, good afternoon, guys, and we will get started. Well, in the last chapter, I introduced the master budget, which is a static budget. But as we know, the focus or the purpose of the budget lies in threefold. First, planning, and then deciding and controlling. Well, by the use of the master budget, we finished the planning step. But in this chapter, we focus on directing and controlling steps as we look at the decisions managers make during the after budgeting periods based on the actual results. So we will use flexible budget to compare the budgeted amounts and the actual results. So in this chapter, we will first of all get familiar with flexible budget as well as standard cost. There are differences between the actual results and the budgeted amounts. This difference is called standard cost variance. So we will get to know two types of standard cost variance, favorable and unfavorable. Then I will identify the benefits of standard cost system. Then we will get to do the analysis to analyze how the standard cost variance differs from the budgeted results between the budgeted amount and the actual results in terms of direct material, direct labor, and manufacturer overheads. Lastly, I'm gonna describe the relationships among the responsibility for the product cost variances and identify how to record transactions in a standard cost system and prepare a standard cost income statement. Well, first of all, we would like to identify what is a flexible budget. Well, as I said, in the last chapter, master budgets focuses on the planning step. And in this chapter, we focus on the flexible budgets, which focuses on controlling and directing. So in the actual results, by comparing the actual results and the budgeted amounts, the managers should ask, first, did my division get its sales goals? Second, have the cost increased? And third, sales have dropped. So do we need to adjust spending? To illustrate the concepts, we will use cheerful colors, which is another fictitious company that makes Korean. Well, here's a little bit background of this company. The company begins the manufacturing process by combining direct materials such as the heated liquid paraffin and dry pigment. The heated mixture is then poured into molds. After the molds cool, crayons are removed, inspected, and boxed into a bulk. The crayons are then shipped to another facility where paper wraps are added to each crayon, and then the crayon are boxed to meet individual customers' needs. This company uses molds that makes 100 crayons each and considers each batch of 100 crayons to be one unit for sales and cutting and costing purpose. So this is a slide illustrating budgeting objectives discussed in the prior chapter. As you can see, in the prior chapter, we prepared the plan, which is the master budget. After the master budget, we did the directing, controlling, and developing strategy steps, where we compare the actual budget, the actual results to the budgeted amount. Before the beginning of the year, let's assume that the company, which is the Cheerful Colors company, I mean, the fictitious company I just introduced to illustrate the concepts in this chapter. Let's assume before the beginning of the year, the company prepared a master budget, where a master budget is a static budget, which means that it is prepared for only one level of sales volume. And the static budget doesn't change after it is developed. Okay, on this slide, it shows a budget performance report. So what is this? This report is a report that summarizes the actual results, budgeted amounts, and the difference. We can see, as I said, before the beginning of the year, the company prepared the master budget, which is a static budget. This is the goal. But at the end of the year, the company has the actual results reported here. We can see there are definitely some differences between the static budget and the actual results, where the differences are listed in the last column, static budget variance, right here. Okay, we can see that the static budget performance report shows that the company's actual operating result is listed here. 36,380 2020. This is 2,000, about a little bit more than 2,000 higher than expected. This number is expected amount, and the actual result is a little bit higher than the expected amount, about $2,000 higher. Okay, we can see this is the difference between budgeted amounts and the actual results, because it is operating income. We want the operating income to be as high as possible. The actual results, we can see the actual results is higher than static budget. So we can say this difference is favorable. That's why we can see an F here, because it is operating income. Again, because it's income, we want the income to be as high as possible. Or in other words, we want the actual results to be higher than the budgeted amounts. That's why we say that this difference is a favorable difference. And that's why we can see F marked close to the difference. And let's see another item. For example, total fixed cost. We can see that the actual result is higher than the budgeted amount, because this is a cost. We want the actual results of cost to be as lower as possible. Or back to this case, the actual results is higher than the budgeted amount, which is unfavorable. So this difference, $2,020, $2,020 is listed in the last column right here with an letter U marked close to it, where U means unfavorable. So here is a quick summary. The difference is favorable if actual amounts increases operating income, and this difference is marked unfavorable if an actual amount decreases the operating income. Well, the report in the previous slide is hard to analyze because the static budget is based on only 50,000 batches of crayons, but the actual results are for 52,000 batches of crayons. So this report raises more questions than it answers. For example, why did the unfavorable amounts in direct material variance occur? Or like, did the workers waste materials, or did the cost of materials increase? Well, these are some questions that the previous report cannot answer. So that's why we need to prepare the flexible budget here. Here is the definition of flexible budgets. Flexible budgets summarizes revenues and expenses for various levels of sales volumes within a relevant range. A flexible budget is simply a series of budgets with different levels of activities. Flexible budgets are useful because they show operating income at several different levels of activities. Flexible budgets are also useful because they help to isolate how variable costs change based on the different levels of activities. So to create a flexible budget, here are some information you will need. Budgeted selling price per unit, budgeted variance cost per unit, total budgeted fixed cost, and the different volume levels within the relevant range. So this slide shows the flexible budget for Chevrolet Colors Company. We can see 3 columns here. 3 columns at different level of sales units. Well, let's assume the column in the middle shows is the same result, same as the master budget. It is the prediction of the units, sales units at the level of 50,000. However, regardless of the sales levels, we know the unit price of sales, the unit selling price, the unit cost for direct material, direct labor, and manufacturing cost. So here it is. And in addition, we can see that we have known the fixed cost here. Well, we can see since it is fixed cost, it doesn't change at each different level of sales. Well, this part are different under different sales level. This part is different in each different column. We can see under sales units to be 50,000, the sales revenue is different from the sales levels in 48,000 or 52,000. And also, under each different level of sales, the variable cost differs. In addition to variable cost, the contribution margin also differs. Differs under each level of activities, sales activities. So here, sales revenue, variable cost, and contribution margin increases as more batches of crayons are sold. But fixed costs remain constant regardless of the number of crayons sold within the relevant range. This is an important distinction to remember about flexible budgets, because total fixed costs remain constant within a specific relevant range of output. Always remember that fixed costs will not change on flexible budgets, but variable cost changes. So let's have a brief analysis about the budget variances. Well, now it is not enough to know that a variance occurs. Managers must know why a variance occurs in order to pinpoint the problems and take corrective actions. Well, as you can see in the previous slide, the static budget underestimated both sales and total variance costs. These differences are caused by two primary factors. There's a difference in price or cost, and there is a difference in volume. To develop more useful information, the managers divide the static budget variance into two broad categories. The first category is flexible budget variance, which means the difference between actual results and expected results in the flexible budgets for actual units sold. And the second category is sales volume variance. It means the difference between expected results in the flexible budget for the actual units sold and the static budget. So here is a diagram. It shows the flexible budgets and sales volume variances. We can see that the flexible budget variance is the difference between the actual results and the flexible budgets, whereas the sales volume variance is the difference between the flexible budget and the static budget. The combination of both variance is the total variance. Is the total static budget variance. So in other words, the static budget variance can be split into two parts. First, the flexible budget variance. Second, sales volume variance. We have seen that the companies budgeted 50,000 batches of crayons during 2019. Actual sales were 52,000 batches. We need to compute the flexible budget variance and the sales volume variance for the company. This slide is the company's flexible budget performance report for the year. Well, next, let's get to know this report. The first column, column 1, shows the actual results based on 52,000 batches of crayons actually sold. These amounts were originally shown in previous slides. I mean, these slides. This is the static budget performance report. And we can extract this part to flexible budget performance reports, as well as the static budget part. We can extract the actual results as the first column and the static budget to the last column. I mean the fifth column. Let's go back. Okay, here it is. We can see the actual results extracted from that slide and static budget extracted also from that slide. And column 3 is the flexible budgets for the 52 batches actually sold. Operating income should have been $33,000 based on that level of sales. Okay, first of all, let's compare the relationship between column 1 and column 3. We can see that column 3. Oh no, I mean let's see the similarity between column 3 and column 5. Column 3 and column 5. I mean flexible budget and static budget. For these two columns, the similarity is that the budgeted per unit is the same amount. This per unit amount applies to column 3, which is the flexible budget. Also, it applies to column 5, which is the static budget. All right. This is the similarity between column 3 and column 5. That is, these two columns have same budgeted amount per unit. All right, this is column 1, 3, and 5. Let's look at column 2 and column 4. Column 2 is called flexible budget variance, which is actually the result, the difference between column 1 and column 3. Column 2 is generated by subtracting column 1 to column 3. Similarly, column 4 is the difference between column 3 and column 5, which is called sales volume variance. And according to the variance analysis I just introduced in the beginning of the class, we mark each variance with the letter U, which stands for unfavorable, or the letter F, which stands for favorable. Well, next, let's see. The standard cost. What is a standard cost? Or what is the benefits of standard cost system? Most companies use standards to develop budgets. A standard is actually the standard unit means the standard unit cost. It is actually the price, cost, or quantity that is expected under normal conditions. For example, the company expects the direct material to cost $1.75 per batch of 100 crayons. So the standard cost for direct material is $1.75, showing here. This is the standard for direct material cost, $1.75. But a budget amount generally indicates a total amount, whereas a standard amount is per unit amount. In the case of direct materials, the standard is $1.75 per batch, and the budgeted amount for 52 batches is $91,000. This company uses a standard cost system, which is an accounting system that uses standards for product cost. A standard cost system allows management to determine how much a product should cost. Each input has both a cost standard and an efficiency standard. For example, the company has a standard for the following. First, The cost it pays per pound of direct materials. And the second standard is the amount of wax it uses for making the crayons, which is called the efficiency standard. Now let's see how managers set these cost and efficiency standards. Well, actually, setting standards can be the most difficult part of using a standard cost system. Setting standards requires coordination and communication among different divisions and functions. For example, the cost standard for direct materials starts with the base purchase cost of each unit of raw material inventory. Accountants help purchasing managers set as cost standards for materials after considering purchase discounts, freighting, and receiving costs. Companies can work with reliable vendors to build relationships that ensure quality and on-time delivery of materials at an affordable cost. For direct labor, accountants work with HR managers to determine the cost standards for labor cost. They must consider basic pay rates, payroll taxes, and fringe benefits. Job descriptions reveal the level of experience needed for each task. A big part of this process is ensuring that employees receive training for the job and are paid fairly for the job. The accountants also work with production managers to estimate manufacturing overhead costs. Production managers identify an appropriate allocation base, such as direct labor hours or direct labor costs, or they allocate overhead using activity-based accounting. Accountants then compute the standard overhead allocation rates. So this slide summarizes the settings of standard cost. Well, next, let's see how the company might determine its production cost standards for material, labor, and manufacturing overheads. First, the cost standard. The manager in charge of purchasing indicates that the purchase price net of discount is $1.65 per pound of paraffin. Delivery, receiving, and inspection as an average of 10 cents per pound. The company's hourly wage for workers is $10 per hour, and payroll taxes and benefits total $2 per direct labor hour. Variable manufacturing overhead will total $37,500 based on 50,000 batches of crayons. Fixed manufacturer overhead is $25,000 and overhead is allocated based on 12,500 estimated direct labor hours. So this slide computes the company's cost standard for direct material, direct labor, and manufacturing overheads on the static budget of 50,000 batches of crayons. The next standard is efficiency standard. Production managers and engineers set direct materials and direct labor efficiency standard. Efficiency standards are also called quantity standards or usage standards because they are a measure of how much input should be put into the manufacturing process. In other words, if employees are working efficiently without wasting materials, how much direct material should be put into each batch of crayons? That amount is the direct material efficiency standards. To set the labor standard, companies can analyze every moment in the production process and then take steps to eliminate inefficiencies. For example, to eliminate unnecessary work, machines can be rearranged for better workflow and less material handling. Another way, the companies set labor standard to utilize continuous improvements, which allow companies to review historical data-based standards and tighten these standards incrementally over a period of time. Companies can also conduct time and motion studies to streamline various tasks. For example, a plant can install a conveyor at waist height to minimize bending and lifting. The companies often develop efficiency standards based on best practices. This is often called benchmarking. The best practice may be an internal benchmark from other plants or divisions within the company, or it may be an external benchmark from other companies. Internal benchmarkers are easy to obtain, but managers can also purchase external benchmark data in order to set the efficiency standards. The use of standard cost system is widespread in manufacturing companies. Using the standard cost system, the managers could prepare the master budget to set target levels of performance of flexible budgets, to identify performance standards, to set sales price prices of products and services or to decrease accounting costs. Standard cost system might appear to be expensive. Indeed, the company must invest upfront to develop the standard, and the standards must be updated on a regular basis, at least once per year. But standards can save accounting work when integrated with companies' ERP system. Business can easily keep track of inventory costs to determine cost and efficiency variances, and also to make real-time decisions based on that data generated from this system. So this is an important part within this chapter. Variance analysis for product cost. Once the standards are established, managers can use these standards to assign cost to production at least once per year. Managers will compare the actual production cost to the standard cost to locate variances. A cost variance measures how well the business keeps unit costs of material and labor inputs within standards. As the name suggests, the cost variance is the difference in cost. And multiplied by the actual quantity used of input. So from this slide, we can see the flexible budget variance can be split into two parts: cost variance and efficiency variance, where cost variance is calculated as actual cost times actual quantity minus standard cost times actual quantity. Where actual quantity is a common part. So, to compute the cost variance, we use actual cost minus standard cost, and then times actual quantity. This is cost variance. Again, the cost variance measures how well the business keeps unit cost of materials or labor inputs within standards. The next type of variance in analyzing the flexible budget variance is efficiency variance, which measures how well the business uses the material or human resources. Here's the calculation of efficiency variance. Standard cost times actual quantity minus standard cost times standard quantity. Where we can see the standard cost is the common part. So, to simplify, we use actual quantity minus standard quantity, then times standard cost. Well, this slide shows the relationship among variances and how to separate total flexible budget variance for materials, labors into cost and efficiency variance. It emphasizes 2 points. First, the cost and efficiency variances add up to the flexible budget variance. Second, static budgets play no role in the cost and efficiency variances. The static budget is used only to compute sales volume variances, which is the variance cost because the company sold a different quantity than it thought. It is never used to compute the flexible budget variance or the cost and efficiency variance for materials and labor. So next, using this, let's try to compute the standard cost variances for direct labor and direct material. Now, let's return to the cheerful colors example. Here, this slide summarizes the flexible budget variance for production cost. We can see there are differences between actual results and the flexible budget. We know that the sales units information should be the same under actual results and flexible budgets. But the difference is this part. The budgeted amount per unit. Well, budgeted amount per unit listed here should be the standard. The standard applies to flexible budgets. However, actually, the actual result doesn't follow the standard. So next, we will do some analysis to see what causes the variances. Is it because of cost variance or efficiency variance? Well, first of all, let's do the direct material variance. Here is some information. The flexible budget variance for direct material is $13,000 unfavorable. Additional data concerning direct material, including standards discussed in the previous chapter, are listed here. Direct material cost standard should be $1.75 per pound of paraffin. Direct material efficiency standard is 1 pound per paraffin per batch of crayons. Actual amount of paraffin purchased and used is 65,000 pounds, and actual cost of paraffin purchased and used is $104,000. So using this information, we can determine the direct material cost variances, which measures the difference between the amount actually paid for direct material and the amount that should have been paid. Or in other words, direct material variances measures the difference between actual cost and the standard cost. This variance measures how well the business keeps unit cost of direct material within standard. First, the company paid less than expected for the direct material. We can use this formula to calculate the cost variance for direct material. We use actual cost minus sales standard cost times actual quantity. Well, the standard cost per unit cost is known here. And the actual cost can be known here. Back to this slide. We use the actual cost for direct material divided by 52,000. This number, this number divided by this number, we get the actual cost per pound. And then times 65,000 pounds. Now we get the direct material cost variance, which shows that the per unit cost per pound is less than the standard cost per pound. In total, the direct material cost variance is $9,750, which is a favorable. Well, this is direct materials cost variance. Next, let's see the efficiency variance. The direct material efficiency variance measures the difference between the direct material actually used and the direct material that should have been used for the actual output. This variance measures how well the business uses its materials. To calculate the direct material efficiency variance, the standard quantity of input has to be determined. The standard quantity of input is the quantity that should have been used for the actual results produced. For the company, the standard quantity of input that workers should have been used for the actual number of crayons batches produced is 52,000 pounds. And according to our formula, we use actual quantity minus standard quantity times standard cost. Well, from the flexible budgets, we know that before the production starts, the managers expected 52,000 pounds be put into the production line. But actually, 65,000 pounds are actually put into the production line. So there is a waste. We use this difference times $1.75 per pound to get a unfavorable $22,750 to be the direct material efficiency variance. So here is a combination of both cost variance and efficiency variance for direct material. For cost variance, it is a favorable $9,750. For efficiency variance, it is unfavorable $22,750. We combine these two variances together, we get the total direct material variance, which is $13,000 unfavorable. So in summary, we can say that this company spends $13,000 more than it should have for paraffin used in production, because first, the workers used 13,000 pounds of direct material more than expected. The inefficient use of the direct material reduced profits by $22,750. And secondly, we can say that the company paid $1.60 per pound of direct material instead of the standard rate of $1.75 for a favorable cost variance. Okay, we use this very similar approach. Using this very similar approach, we can do the direct labor variance analysis. For direct labor variance, we also have two types: cost variance and efficiency variance. Well, first of all, let's use the information provided here to calculate the cost variance. The cost variance measures the difference between the actual amount paid for direct labor and the amount that should have been paid, or the difference between actual cost and the standard cost. This variance measures how well the business keeps its unit cost of labor input within standard. To calculate the direct labor cost variance, we use actual cost minus standard cost times actual quantity, or $14 per direct labor hour minus $12 per direct labor hour times the total direct labor hours used for production. We get the unfavorable $20,800 as the direct labor cost variance. And similarly, we use the similar formula to calculate the direct labor efficiency variance. We use actual quantity minus standard quantity times standard cost. We can get a favorable efficiency variance to be $31,200. Well, similarly, combining these two variances, cost variance and efficiency variance, one is favorable and the other one is unfavorable. Well, this slide here shows the incorrect numbers, but I mean, if we combine the efficiency variance showing here on this slide and the direct labor cost variance showing on this slide, combining these two parts together, we can get this favorable difference as $10,400 as the direct labor variances. So in this class, we do the analysis of direct labor variances and the direct material analysis. Well, in the next class, we will use very similar approach to see how the standard cost can be used to determine the manufacturing overhead variances. Well, according to our syllabus, there will be no class on this Wednesday. There will be no class on next Monday. These two classes are reserved for you to develop the second summaries. The second summary. So before I leave, please let me know if you have any questions. Or I will see you on next Wednesday. Bye guys. See you.